In 1999, at the absolute peak of the dot-com bubble, the most celebrated investors on Wall Street were laughing at Warren Buffett. He wasn't buying tech stocks. He wasn't riding the wave. He was sitting on cash, reading annual reports, and doing absolutely nothing exciting. The press called him outdated, washed up, a relic of a bygone era who no longer understood the new economy. Then the bubble burst, and while the Nasdaq lost 78% of its value, wiping out trillions of dollars and destroying the retirement savings of millions of ordinary people, Warren Buffett emerged virtually untouched, not just intact, stronger. So what did he know that everyone else didn't? He knew one book, one framework, one set of principles so powerful, so enduring, that he has called it, publicly, repeatedly, the best book about investing ever written. He read it at 19 years old, and it changed the entire trajectory of his life. That book is The Intelligent Investor by Benjamin Graham, written in 1949, still the most important text in the history of stock market investing. And today, we are going to break it down completely. The core ideas, the timeless principles, and the one mental model at the heart of it all that Wall Street desperately does not want you to understand. Because here's the truth. The stock market is not a casino, but most people treat it like one. And by the time this video ends, you will understand exactly why and exactly how to never make that mistake again. Stay with me, because the very first idea in this book is one that will permanently rewire the way you think about money. Who was Benjamin Graham? Before we get to the principles, you need to understand the man. Benjamin Graham was not a theorist. He was not an academic writing from a comfortable distance. He was a practitioner, a street-level investor who learned these lessons the hard way, in the blood-soaked ruins of the 1929 stock market crash. Graham watched fortunes evaporate. He watched brilliant men, educated, sophisticated men, lose everything they had built because they had no framework, no discipline, no defense against their own psychology. He survived when others didn't, and then he spent the rest of his life asking one question. What separates the investors who survive from the ones who are destroyed? The answer he arrived at was not what the industry expected. It wasn't about intelligence. It wasn't about access to insider information. It wasn't even about picking the right stocks. It was about temperament, about having a philosophy, a set of unshakable principles that guided every decision, especially when the market was screaming at you to abandon them. He codified those principles into The Intelligent Investor, and his most famous student, a young man from Omaha named Warren Buffett, absorbed them so completely that he went on to become the greatest investor who ever lived. So what are those principles? Let's start at the very beginning, with an idea so fundamental that Graham places it in the opening pages, and yet it is almost universally misunderstood. Principle 1. Investment versus speculation. Most people think they are investing. They are not. They are speculating. And the difference between those two things is the difference between building wealth and gambling with your financial future. Graham draws a razor-sharp line between the two. An investment, in his definition, is an operation that upon thorough analysis promises safety of principal and an adequate return. Every word of that definition matters. Thorough analysis, safety of principal, adequate return. Not spectacular, not explosive. Adequate. Speculation is everything else. Buying a stock because it's been going up and you expect it to keep going up, that's speculation. Buying a meme stock because everyone on social media is talking about it, speculation. Piling into crypto because you're afraid of missing out, speculation. Investing your savings into a company whose business you cannot clearly explain in 2 sentences, speculation. Here is why this distinction matters so enormously. Speculators can win, sometimes spectacularly, for a while, but speculation is fundamentally a game of timing and luck, and no one wins that game consistently forever. Eventually the tide turns, and when it does, the speculator has no foundation to stand on. The investor, by contrast, is playing a completely different game, one where the odds are structured in their favor over time, one where patience is the primary competitive advantage, one where the goal is not to be brilliant, just to be rational. Graham didn't say speculation is evil. He said, know which one you're doing, because confusing the two is what destroys people. Right now, ask yourself honestly, the last financial decision you made with your money, was it an investment? Or was it speculation dressed up in the language of investing? That question is uncomfortable. Good. Discomfort is the first step toward clarity. And speaking of clarity, the next principle is built on the most powerful mental model in the entire book, one that Graham invented, one that Warren Buffett has called the most important idea he ever encountered. His name is Mr. Market, and he is about to become your most useful and most dangerous acquaintance. Principle 2, Mr. Market. Imagine you own a small business, and you have a business partner. Call him Mr. Market. Every single day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you more of his share at a price he names. Without fail. Here is the thing about Mr. Market. He is wildly, clinically unstable. Some days he shows up euphoric. The business is fantastic, the future is bright, everything is wonderful, and he names a price that is absurdly, irrationally high. Other days, he arrives in complete despair. Doom is imminent, catastrophe is coming, everything is terrible, and he offers to sell you his share at a price that is almost insultingly low. Now, the critical question, should his mood affect your behavior? Only if you're irrational. His offer is information. It is not an instruction. You are free to sell when his price is high, buy when his price is low, or simply ignore him entirely until he offers something that makes sense. The stock market, Graham tells us, is Mr. Market. It is a daily auction, a popularity contest driven by emotion, fear, greed, and narrative. Prices swing not because the underlying value of businesses is changing dramatically every day, but because human sentiment is changing. Because people are scared, or greedy, or bored, or following headlines. Most investors treat Mr. Market's daily prices as objective truth, as a signal they must respond to, and that is exactly what destroys them. The intelligent investor treats Mr. Market as a servant, not an advisor. When he's panicking and offering shares of a great business at a ridiculous discount, you buy. When he's euphoric and paying too much for ordinary businesses, you sell or you wait. This is the foundation of Warren Buffett's most famous line. Be fearful when others are greedy, and greedy when others are fearful. That line did not come from a genius in a laboratory. It came from Benjamin Graham in 1949, translated into 4 words. Now, if Mr. Market is the emotional character of the market, the next principle is the intellectual framework you use to operate within it. Graham called it the margin of safety. And it is, perhaps, the single most important concept in this entire book. Principle 3, margin of safety. Never pay full price for anything. That's the core of it. But the elegant depth underneath that simple statement is what makes Graham's framework so powerful. Every stock has 2 prices, the price you pay, which the market sets, and the intrinsic value, which the business actually represents. The gap between those 2 numbers is your margin of safety. Think of it like buying a house. You hire an inspector, and they tell you the house is worth $500,000. If someone offers it to you for $300,000, you have a massive margin of safety. Even if the inspector was slightly wrong, even if the market cools, even if the roof needs work you didn't anticipate, you are protected by the gap between what you paid and what it's actually worth. Now imagine you paid $550,000 for that same house, because everyone else wanted it and you were afraid of missing out. Now you have no margin of safety. The house needs to perform perfectly, the market needs to cooperate, and nothing can go wrong, because you have no cushion. You bought at full price, with no protection. Stock market investing works exactly the same way. The margin of safety principle says, Only buy when the price is significantly below intrinsic value. Not slightly below, significantly below. Because you will be wrong sometimes. Your analysis will have errors. Markets will behave unpredictably. The margin of safety is your protection against your own inevitable mistakes. This is how Buffett survived the dot-com crash. The technology stocks everyone was buying in 1999 had no margin of safety. They were priced for perfection in a world that never delivers perfection. When reality arrived, there was no cushion. Everything collapsed. Buffett's positions, boring, unglamorous, carefully priced businesses bought at significant discounts to their value, had enormous margins of safety. They absorbed the shock, and when the panic cleared, they were still standing. One question before we continue. How do you calculate intrinsic value? That's a deeper conversation for another video. But broadly, it involves analyzing a company's earnings, assets, growth trajectory, and competitive position over time. Graham's broader message is simple. If you cannot estimate value, do not buy. Uncertainty is not a reason to speculate. It is a reason to wait. Now here is where it gets personal. Because the next principle is not about stocks at all. It is about you. And it is the one that Graham believed most people would fail to implement, regardless of how much they understood everything else. Principle 4. The defensive investor versus the enterprising investor. Graham draws a crucial distinction that almost no one talks about. He says, before you develop an investment strategy, you must be brutally honest about who you actually are. The defensive investor, also called the passive investor, is someone who does not want to spend significant time and energy analyzing individual stocks. They want to build wealth, protect their capital, and not be consumed by the process. This is the vast majority of people, and there is absolutely nothing wrong with it. For the defensive investor, Graham's prescription is elegant in its simplicity. Own a diversified mix of high-quality stocks and bonds. Rebalance periodically. Never try to time the market. Never chase performance. Stay the course when everyone around you is panicking. In modern terms, this looks like low-cost index funds. Broadly diversified, passively managed, held for decades. Simple, boring, devastatingly effective over time. The enterprising investor is someone who is genuinely willing to invest the time, energy, and intellectual effort required to analyze individual businesses deeply. Not because it's fun, though it can be, but because they are prepared to treat investing as a serious part-time vocation. For the enterprising investor, the rewards can be higher, but only if the effort and discipline are genuinely present. The fatal error, Graham warns, is thinking you are an enterprising investor without actually being one. Dabbling in stock picking without real analysis is not enterprising investing. It is speculation with extra steps. So which are you? Honest answer. Because the wrong answer to this question has bankrupted more people than almost any other mistake in finance. Most people, if they are truly honest, are defensive investors, and the defensive path, executed consistently over a working lifetime, creates profound, lasting wealth. The S&P 500 has returned roughly 10% annually on average for the last century. An ordinary person who simply owned the market and never sold in panic would have retired wealthy. The problem is never the strategy. It is always the behavior. Which brings us to what might be the most important chapter in the entire book, and the most overlooked, the one where Graham dissects the single greatest enemy of the intelligent investor. Principle 5. The investor's chief enemy is themselves. Graham was a financial genius, but he was also a psychologist. He understood, decades before behavioral economics became a field, that the primary reason investors fail has nothing to do with math. It has everything to do with emotion. He identified two forces that destroy rational investment behavior. He called them by their true names: fear and greed. When markets are soaring, greed takes over. investors extrapolate recent performance into the future indefinitely. They take on more risk than they can bear. They buy assets at prices that can only be justified if everything goes perfectly from here forward. They feel invincible. When markets crash, and they always crash eventually, fear takes over. The same investors who bought aggressively at the top panic and sell at the bottom. They lock in devastating losses, they swear off stocks forever, and they miss the recovery that inevitably follows. This cycle, buy high in euphoria, sell low in panic, is the single most common pattern of wealth destruction in the history of markets. And it is almost entirely driven by psychology, not ignorance. Graham's prescription: build a system and commit to it before the emotional storms arrive. Decide in advance how you will behave when markets drop 30%, when your portfolio is down significantly, when every headline tells you that this time is different, that everything is collapsing, that you need to do something. Your answer, if you are a defensive investor, should always be the same: nothing. Buy more if you can afford to. Do nothing if you can't. But never sell in panic. The investors who built the most wealth in modern history didn't do it by being the smartest people in the room. They did it by being the most disciplined. By having a philosophy strong enough to hold when their emotions were screaming at them to abandon it. It always has been. Principle 6. The danger of forecasting. Here is something the financial media industry does not want you to realize. Nobody knows what the market will do next. Not the analysts on television, not the hedge fund managers charging 2 and 20, not the economists with Ivy League PhDs and Bloomberg terminals on 3 monitors. Nobody. Graham was almost contemptuous of market forecasting. He devoted significant space in The Intelligent Investor to demonstrating, methodically, that predictions about short-term market movements are essentially worthless. The track record of professional forecasters is, to put it charitably, no better than chance. And yet the entire financial media ecosystem is built on forecasting. Because forecasting is entertaining. Confident predictions about where the market is going next quarter make compelling television. They give investors the feeling that someone is in control, that the chaos can be managed and predicted. It is an illusion, and an expensive one. The intelligent investor's response to an unpredictable market is not to predict it better. It is to build a portfolio that does not require accurate prediction to succeed. Diversification, margin of safety, long time horizons, consistent contributions regardless of conditions. Systems that succeed not because you timed the market perfectly, but because time itself is doing the work. Stop watching CNBC for investment advice. Stop following analysts whose predictions are entertainment, not research. Focus on what you can control, what you buy, at what price, and how you behave when the market misbehaves. That focus, that narrow, disciplined, unsexy focus, is the entire game. The last word. Let's bring this together. Benjamin Graham spent a lifetime watching intelligent people fail in the stock market. Doctors and lawyers and professors. People with every intellectual advantage and no philosophical framework. He watched them buy high and sell low and follow crowds and chase narratives and wonder why they never got ahead. And then he watched his students, people who internalized his principles completely, build extraordinary, lasting wealth, not through brilliance, through discipline. Here are the principles one final time. First principle. Know the difference between investment and speculation, and be brutally honest about which one you're doing. Second principle. Mr. Market is your servant, not your master. His moods are your opportunity, not your instruction. Third principle. Never buy without a margin of safety. Pay less than the business is worth, always, without exception. Fourth principle. Know yourself, defensive or enterprising, and choose the strategy that you will actually execute consistently over decades. Fifth principle. Your greatest enemy is your own psychology. Build systems, commit to them in advance, honor them when it is hardest. Sixth principle. Ignore forecasts, focus on process. Let time and discipline do what genius cannot. Warren Buffett keeps a copy of The Intelligent Investor on his desk. He has for over 60 years, not because he needs to reread it anymore, but as a reminder, a talisman, a symbol of the philosophy that built his empire. He has said, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions, and the ability to keep emotions from corroding that framework. Graham gave him that framework at 19. You have it now. The only question that has ever mattered, what you decide to do with it.